Hello, everyone, and welcome to your Women's Growth Series. I'm Corey Meredith, the social media specialist here at AIME, and I'm so excited to be your host today. I'm joined by Mike Socha and Angela Wyckoff, and today we are talking about working with clients who have unconventional careers. So, Mike, if you want to give a quick introduction about yourself, and then Angela, and we'll get right started.
Sure. Hi, everybody. My name is Mike Socha. I am the owner of the Socha Lending Group. We're located here in beautiful Denver, Colorado. I've been doing mortgages for, goodness, 16 years or so. I started out in retail, made the move over to the broker side, and never been happier.
Well, welcome to the broker side. I know it's been some years, but hey, you made the leap, and that's all that matters.
Love it. Thank you.
You're welcome. Thanks for being with us. Angela, how about you?
I have been in the mortgage industry 20 years. I started in the lender channel. I've done everything from A paper to F paper, I will say. And now I'm on the broker side and submitting them the opposite direction.
Awesome. Well, thank you so much both for being here today. I'm really excited about today's discussion because it's a topic that not many people are super educated about, including myself. So I'm excited to learn more from each of you today. So Mike, I'm going to start with you, but can you just give us a time when you worked with a non-QM client and how that situation kind of unfolded?
Sure. So I think that there's a lot of different people that could really benefit from a non-QM loan. I work with a lot of self-employed borrowers, especially that use non-QM loans, and also investors that use non-QM loans. Specifically, one example, I actually have a client who she runs an Airbnb property management service. So she helps people that do Airbnb to actually run their business itself. She's been doing it for about 2 or so years. She makes very good money, but she writes literally everything off on her taxes. So she did not qualify for any of the traditional channels, but she makes a lot of income. So we were able to do a 12-month bank statement loan for her. She qualified for over $500,000 at a not so bad interest rate. Clearly not in the twos, but it was good for her. And she was just absolutely ecstatic that she was finally able to be a homeowner. And she actually now runs an Airbnb herself out of the top floor of the house that she ended up buying through the non-QM loan. So she is not only the president, she's also a client now.
That's awesome. What a story. Angela, what's your most recent or story that sticks out to you the most when working with non-QM clients?
Well, a lot of the non-QM clients have very, very crafty CPAs, which is why they can't go conventional. They make a ton of money, but they also don't want to give it away. So they will filter everything through their bank statements, which will allow me to find them some financing. And like Mike said, the rates are not in the twos, but at least they have the ability to leverage, getting a mortgage.
Definitely. And you both touched upon it, the interest rates. And it's no secret that this year has been record low interest rates, quarter after quarter, month after month. So because non-QM is slightly different and a little bit more untraditional, how has COVID, Mike, I'll toss this one to you first. How has COVID affected non-QM loans, or has it even affected non-QM loans?
So I would say maybe I would break it up into two different parts. So as far as the rates are concerned, I would say it's kind of similar as to what it was before COVID. A lot of that has to do with investors. So you have to understand that these are not backed by Fannie or Freddie, and therefore they are all investor-backed loans. The investors have to make their money somehow. These are riskier loans. So the interest rates have kind of stayed similar. They might have improved a little bit, but a lot of them are investor-backed. So as far as the rate is concerned, a little bit, but maybe a little better, but pretty similar. In terms of the actual loans themselves, I don't know if some of these were out there before. I personally didn't have them with any of my non-QM lenders, but I've seen some changes in term, meaning before, like for instance, with the bank statement loans, they needed a year or 6 months. Now I'm seeing even 3 months kind of out there. I just heard about one that's 2 months. And I think a lot of that has to deal with the fact that COVID has affected a lot of businesses, and they're starting to really ramp back up and really get back into it. And so I think that they're offering some different terms. So that's been a little bit different with COVID from what I've seen.
More products, more differentiation that gives us more options. So overall, even if you've seen so many changes or not so many changes, just having those more options is key too. So Angela, have you noticed anything drastic or maybe not so much in terms of COVID and non-QM lending?
Yes. So the LTV restrictions is one thing. So the loan amounts are capped, the loan to value are more restricted, and then of course the cash out that's available to the borrower, some lenders have really tapered back.
That's good to know. Definitely good to know. But one thing that's also super important is to be upfront with your customers too. So we always preach this to any customer, not just non-QM clients, but let them know from start to bottom what they can expect so that there's no surprises along the way. So Angela, when it comes to you and your clients, what do you kind of tell them right off the bat, especially non-QM, like what can they expect or what things do you want to just clarify before even jumping into the process?
Some of the things I let them know is that, this is not a cookie cutter loan, so they have to be patient, which a lot of times people with tricky income may or may not be. So, just make sure that they provide all their documents up front, because the worst thing is continuing to ask for more or not getting the correct amount of bank statements up front and properly calculating their income. So they just have to have a little bit more patience. And then I just walk them through and then I give them updates. Hey, you know what, your file's in underwriting, we're still looking at it. As long as you keep them appraised and don't like ghost them for 3 weeks, then, obviously they'll have a little bit more of a comfort level and be able to trust that you're trying to get them the best situation.
Absolutely. Building that trust is huge, especially when you're trying to create long-term clients, which the client for life cycle is so important to us. So Mike, do you share similar insights with your clients too?
Absolutely. I would also maybe add just a couple more things. So a lot of these loans have other pieces to it. So for instance, they have a prepayment penalty unless you buy it out. They have the option sometimes to do interest only. They have reserve requirements. So making sure that all these different pieces are told upfront, so you're not halfway through or most of the way through and saying, hey, I need you to show 6 more months worth of reserves. It doesn't come as a surprise to them. And then also kind of explaining there's different pieces, different parts to different kinds of non-QM loans. So depending upon which one you're doing. So for instance, we keep talking about bank statement loans, but there's also some other ones like asset depletion loans and then DSCR, debt service coverage ratio loans, which I'm sure that we'll touch on in a minute. But just making sure that depending upon which program that you're actually using, that you go through all the intricacies and explain it to them.
Yeah. And actually, Mike, that's a great segue. And I'll let you just have the floor on this one. But you were telling me a little bit about your DSCR secrets and how you're able to accomplish these types of loans. So as much of your secrets as you want to give away, I'll leave up to you. But if you could just let our audience in on some types of insight that you have when it comes to this.
Absolutely. Happy to share my secrets. So I deal with a lot of investors. A lot of them want to do things like Airbnb or VRBO or short-term rentals. And so the DSCR loan actually lends itself really well to this type of loan. So as most of us have probably run into, Airbnb income doesn't really count. But it doesn't really count with a lot of our lenders, depending upon how they do it on their taxes, et cetera. So the DSCR loan, if they have enough to put down, which can range between 20, 25, 30, sometimes more, depending upon the lender, can be a really good option. So DSCR stands for debt service coverage ratio loan. Basically, it is a little less dependent upon the actual person doing the loan, a little bit more on the actual cash flow of the property. So credit score still comes into play, but really what they do is they run an appraisal for the market value for the rent. It's called a 1007 appraisal. Okay, so they do 2 appraisals. They do one for the actual value of the property, one for how much rent it could come in at in the market, and then they look at how much is the mortgage going to be, how much could they get in rent, and they do some sort of a ratio, and depending upon what that ratio comes up at is a set of different interest rates. And then from there, that's really what the loan is mainly based upon. There's some other factors, but that's really the big part of it. A lot of them have an interest-only option. So it bumps the interest rate just a little bit, but they are able to get interest-only option. And if the point for a lot of these investors is actually cash flow. Bump the rate a little bit, do the interest only option. There you go. Now you're cash flowing on a property, and then they're able to really acquire quite a few.
Yeah, those are all super great insights and reasons why we should engage with each other in these groups and listen to these calls, because we're all mortgage experts in our own area, and not everyone does non-QM loans. As Angela said, they're not cookie cutter loans. They can be a little bit more in depth because you have a longer waiting period. You need to get different type of paperwork. They're unconventional careers at the end of the day. So Angela, I'll toss this one to you, but why do you think that it's beneficial for brokers to bring in a non-QM line into their product lists?
Just because a lot of people think that they can walk into a Chase Bank or a Bank of America or Wells Fargo, some brick and mortar, and they'll be able to get the financing that they're looking for. And I've had many a client say, I've got so much money with them, but they're not going to lend to me. And then I'm like, okay, well, let's deep dive. Let's take a look. Let's look at your tax returns. Let's look at the bank statements. Let's see what we can come up with. And I provide them a solution that they wouldn't have been provided elsewhere. They are just told they are declined and no other reason. So, I do try to work with them and say, hey, let's team up. Let's work together. Let's see what I can come up with. And, like I said, set the expectation and let them know. Sometimes I'll double up it, and I'll see, because one particular lender looks at only the or only provides a certain portion of the deposits, and some will use all of them. So it definitely depends on the particular customer situation, but it's a huge great thing to have in your arsenal, because you're not going to miss out on all that business that the other lenders are turning down.
Yep. And at the end of the day, we always say that we're here to help the most consumers. Most consumers become homeowners. And with so many unconventional jobs just in the mix between what we talked about, Airbnb or real estate agents, Mike, why do you think that it's a good option for brokers to add non-QM loans to their resume?
So I think that we are differentiating ourselves in the space. And I think that that's very important, kind of the difference between a broker and a retail banker. And to be able to offer so many different things means that you truly are the consultative partner to anybody, really, because we can try to come up with solutions as long as everything makes sense. And the fact that we truly are able to kind of shop around, we have different programs for everybody that could hopefully fit almost anybody's needs. We can really help with just general home ownership, whether it's investments or primary, to be able to get people into houses, which at the end of the day, I think is a really strong statement for us to be able to say, hey, I have a program for that. Your bank doesn't. Why don't you work with your independent local person, support a small business, and hey, by the way, we're able to get you into this house.
Yeah, just another reason why brokers are better, really, at the end of the day.
Absolutely.
Those options, they go a long,
Amen.
long way. But talking about adding these things to your product list, like there's going to be some roadblocks, there's going to be some learning curves. So Angela, I'll toss this one to you, but what is the major roadblock that you would have to give to a broker who may want to get started with non-QM and they're just not sure what to expect?
Well, using your rep. You got to use your rep. You really have to make them help you and, work for your business too, because a lot of times the rep will be like, oh, just send it in. And it's like, no, you know what? I need to make sure that I'm in a certain rate bracket. I need to make sure that they, have this certain particular product. So a lot of times I'll send them a skinny package just so that they can vet it. These particular clients are super important. They're, I have one particular client that has a pharmacy in Beverly Hills, and, the tax return is very, very, skimpy and the bank statements support a lot of income, and this person relied on me to get them financing, and now they're coming back to me for a refinance. So it's just giving them an outlet to be able to service more people, and then of course that person probably knows someone else that has income that isn't reported to the government and will need assistance as well, and they'll come back to you.
You frame yourself as that mortgage expert for that person, again, based off
Yeah.
that client cycle. So Mike, what's a roadblock that you would let brokers know about when dealing with non-QM loans?
Yeah, so I think that a lot of us are really used to using the QM services, and a lot of the QM services have really great technology. I would say that
Mm.
most of the non-QM lenders that I've used, it's paper, like it's very paper based. So you have to keep changing the pieces of paper, saving them and sending them back to them. Some of them have an okay TPO platform to where you're able to log in and you're really able to upload the different pieces of paper. But a lot of times it's very email based. So I think organizationally, you have to make sure that you have things like, I don't know, we have a Google Drive to be able to save everything so that you're making sure, especially if you have multiple people at your brokerage, that it doesn't get kind of lost in the shuffle. So I would say just making sure that logistically that you have a way to be able to make changes, provide things, and expect it to be more paper. I think from a compliance standpoint too, you also have to be on them just a little bit more to provide the packages, to provide the LEs, because they are not TRID loans, so they don't really have the same time frames that we might be used to in the QM world. And so we have to be on them just a little bit more and kind of keep on it. And then the other thing too, I would say, is just general product knowledge. It's different based upon which lenders you sign up with. So just because you know the non-QM space at one lender doesn't mean it's going to be completely different at another one. So I would say anytime that you sign up a new lender, make sure that you fully understand kind of the ins, outs, and differences between all the different products that they offer, even if the products seemingly are the same as what you already offer, because there's a lot of differences between lender.
Definitely. And that was actually a great segue into my next question. And you touched perfectly upon it, is the organization. Now, there are not as many options available for organizational purposes, such as like technology. And you said it there, it's a lot more paper. So Angela, I'll throw it back over to you, but how are you and AmeriFirst able to stay organized when you take on those non-QM loans?
AmeriFund.
Yes, I'm sorry.
We have Salesforce. It's okay. We use Salesforce to track all our leads. Now the non-QM is a little bit more tricky. I do, go a little old school on that one and use an Excel spreadsheet. Only because I track my lenders and I show, this one has a maximum loan amount of 3 million. This one has a maximum loan amount of 4 million. This one's unlimited, but they have a floor rate of 4.5. And if I know my borrower is not going to go there, so it gives me that flexibility to look at a glance to see if who my players are. I use Salesforce for the follow-up and the tracking, but I also use my Excel spreadsheet to kind of see who my players are and who I'm going to submit to and who's going to give me the best deal. Because I do essentially blast email all my reps and I say, okay, what product do you have for this? They only have bank statements. This is their FICO. This is their loan amount. This is the loan to value. And then I blast it out, and then they come back to me with their particular product or reserve requirements. And then I load it onto my spreadsheet and go, okay, these two are out of the 11 that I'm using right now. These two are the top players, and these are the ones that I want to submit to. And then I drill down and see and make sure that my customer hits all those check marks.
Great. Yeah. I mean, it's always a system of processes and what works for you. So Mike, you said that you guys have Google Drives, but is there anything that you want to explain that you can expand on that? How do you use the Google Drives in order to stay organized within your team?
Sure. So we have different lenders. We have about 11, I would say, as well as Angela, for different non-QM lenders for different reasons. They all have different loan to values. They have all different requirements. So really what we do within the Google Drive is all of them have their own forms. So I have, for my employees, I have an employee drive where I have the different lenders labeled with the different forms. So that way they're able to kind of go and grab. Then within each of my employees' folders, they have a folder specifically for each client. And then that way, what they're able to do is just grab the forms, save them into the client folder, and then we use a PDF software so that they're able to kind of type over the forms. And then that way there's kind of saved right there. If I need to look, or my operations manager needs to look at anything, they're all right there, kind of accessible to the people that should have accessibility to it. And we use Arrive. And so we're also able to upload some of the documents within Arrive. We're able to take Arrive and tweak the list of the documents that we need, and then be able to send that directly to the borrower, so that they don't just have the default list that is for QM loans. We're able to tweak it for non-QM loans as well, because there's certain things that are kind of across the board, things that you'll need that you can default if they choose a non-QM product.
Very nice. Yeah. So different processes, but they both work for your teams. And I think at the end of the day, it's just about staying on top of your pipeline. I mean, everyone has a pipeline, regardless if you're doing FHA loans or non-QM loans. It doesn't matter. You always have to stay on top of what you're doing. And we do a really good job at that in the broker community. Everyone is very adamant about getting those clear to closes and making sure that their clients are happy at the end of the day. When we talk about lenders and the different guidelines that we have, and educating on those different products, because they, like you said, are different from lender to lender. So what are some different lender guidelines that you have been faced with in adapting new lenders? Angela, I'll kick it over to you.
Well, the guidelines are pretty, either they use a percentage of the bank statements, or they use the full deposits. You pretty much, I like to do the lender spreadsheet. A lot of times they'll have a spreadsheet for those types of loans, and then I'll pre-load it so that I know what to expect as far as income. Otherwise, the guidelines themselves are just going to be specific to each product. And across the board, most of them are the same, except for, of course, the reserve requirements and, like Michael had mentioned, the prepayment penalties, whether they're offering a 5/1 ARM or a 30-year fixed. So as far as guidelines, you just have to, collect all the documentation and send it in, and then just go from there. Unfortunately, you kind of have to fly by the seat of your pants a little bit on these types of products.
You learn as you go and you get used to it. Mike, do you have anything else you want to add in regards to lender guidelines?
I mean, I would agree with Angela. They're all just a little bit different based upon which lender that you choose. As you tend to start to work with the lenders, you start to understand what they're looking for a little bit more. I do think reserve requirements is a really important thing that you ask for upfront. Some are different. What is your prepayment penalty? Some start at 3, some start at 5. Do you offer interest only, et cetera, et cetera? So just kind of knowing that upfront is really important, I think, before you select a lender.
Mm-hmm. Getting all of your pennies in a row, or your ducks in a row, I should say. So we touched upon this a little bit, but I'm just gonna wrap it up. It's been great to pick both of your brains and get your insights about non-QM. It's definitely something that I wanted to learn more about, and I think that I did, and I hope everyone watching learned a little bit more about it too. But if there was just any piece of advice coming from yourself, what would you say to brokers who are looking to work more with clients who have unconventional loans? And Mike, before I toss this over to you, I know you're from Denver, and I know that dispensaries are getting big in the Denver area. So maybe can it be fearful tackling taking on clients who have those unconventional careers? Have you seen a spike in this? What would you say to brokers who are looking to go down this route?
So I would say jump in. I mean, there's nothing really stopping you. It's it's up to you whether you want to add this product line or not. The AEs in almost every one of these lenders have just been phenomenal, like absolutely phenomenal. Like, this is their job. They know that these things are a little trickier, that most brokers are just starting to get into them. It's a newer kind of loan. So they're there for you. So I would say just kind of do your diligence a little bit on which lenders you want to associate yourself with first, because just know that they are all just a little bit different from each other. But just jump right in, ask your questions. Don't be afraid to lean on your AEs, especially if you find a really good one that you feel really comfortable with. I would say jump in. Now's the time to learn, because it's only going to grow and grow and grow, kind of as more and more people are jumping into these non-conventional careers, starting things with after COVID, et cetera. You also touched on the Denver dispensary thing. So I would say whether it's most of them are non-QM. What I have been seeing from a lot of these non-QM lenders, of course, all of them are different, is that if somebody is in a state where it is legal, like that, where marijuana usage is actually legal, that it's a little different if the person owns the company versus if they actually work for the company. I think it probably has to do with a lot of risk, compliance, etc. But it seems like they're more amenable to people that work for the company than own the company, to be able to give them income and be able to lend to them.
Great piece of advice too. Angela, what would you have to say to brokers who are wondering about the non-QM product line, but they're not sure exactly how to take it on, or they're interested in helping people with unconventional careers? Are you along the same guidelines as Mike with the just jump in attitude?
Absolutely. Jump in, because they are not getting a loan anywhere else. So you have to be that resource that has a loan for every borrower. And, you know, I rarely am turned down someone because I can't find them a loan. So, you know, it has to be like, you know, a terrible FICO and just not the right loan to value, etc. But this is an opportunity for you to just get that much more business. So don't turn it down. Find a solution. There is a lender out there, you know, 9 times out of 10 that will provide financing for your borrower. So it's just, it's up to you to jump out there and grab it.
And Corey, if I could just break in real quick.
Yeah, absolutely.
I totally agree with that. I wholeheartedly think that that is a big service that the broker community provides, is the fact that we do not work for one specific lender. We are able to shop around. We are able to be that voice and be that advocate for our clients to be able to find them what they need. And so I would encourage a lot more people in our space to expand their overall number of lenders to be able to include a lot more programs and products for our customers, so that we can, as a broker community, be able to say, yes, we have a ton of different products that the retail space just does not have. And so that we can build just brokers in general up, so that we can be that advocate for them, for our customers, to be able to find them whatever it is they need to be able to increase homeownership across this country.
Yeah, I love that point. I mean, I've said it so many times just in this live today, but I say it all the time anyway. Like, brokers are better because we want to help more consumers become homeowners. And what better way to do that than to increase our product lines and actually go out there and help more consumers become homeowners by offering products like non-QM that the retail market just can't do. So I want to thank you both so much for your time today. It was so great talking to you. You both are clearly experts in the space. So I know that if anyone has any questions about non-QM loans, one of the best places to go to is the WMN group or Brokers Are Better group, because we're here as a community to build, support, grow, and together prove that brokers are better. So thank you both so much again, and we'll talk to you soon.
Thank you, Corey.
Thanks for having me. Take care.